Welcome to the Marathon Financial Statement Analysis. My name is Jake Jacoby,
I'm Zach Ross.
And I'm Leonardo Byer.
and this is our presentation. We did ours about Marathon. Marathon is a petroleum corporation, is a leading integrated downstream, midstream energy company headquartered in Findlay, Ohio. They have been around for over 100 years, since 1887, and they produce 3 million barrels of oil per day. Looking at their ratios, their current ratio and how the liquidity ratios are looking at how good they can pay off their liabilities. So their current ratio for the recent years has been pretty high, but in 2024 we see it go down a little bit. So this is just showing that they do not have as much assets to pay off their liabilities. For the quick asset ratio, the quick ratio, we see the same trend again in 2024. It's a bit lower than in the recent years, so they're not able to pay off their liabilities as easy. They're becoming less liquid. They can't use just cash and their receivables. Then for the cash ratio, see it's pretty low again, and so they are not very liquid this year or very recently. So they're taking on some liabilities and they're not able to pay it off as easily as recent years. So we look at the industry average, we see again they're quite a bit below. Their current ratio is not doing so hot. None of their ratios are doing very good in the most recent year, but that is just a recent trend. Hopefully it will go back up. Now for the leverage ratios, debt to asset ratios, the amount of assets they have that are financed through debt. It's been pretty consistent these 4 years, not terrible, not very high. They have quite a bit of debt to how many assets that they have. And then for the debt to equity ratio, you see that was pretty high in this recent year. The debt to equity ratio is they have a lot of their equity that is financed through debt, and so they are making money based on their debt, but they have a lot of debt. So their interest coverage ratio, their earnings before taxes divided by their interest, they can pay off their interest pretty easily by 5 times, but again it's been lower this year. It's gone up and down, but they're still able to pay off their interest. So in recent 2024 they must have taken on more interest and they're not as able to easily pay it off.
Alright, so as you were saying, it's just how good they get capital from their debt. So as you can see, they have the lower ratios compared to the industry. For the debt to asset, it's 0.36 compared to 0.61, which is quite a big difference. And then debt to equity is also less. It's not much less than the industry average, but it is less. And then for the interest coverage ratio, they do go up compared to the industry, which just means that they can't pay off all their interest debt with all the assets they have. And then here you can see the efficiency ratios. It just shows how efficient a company uses their assets. So for the asset turnover ratio is pretty consistent between all 4 years. Inventory turnover ratio was also pretty efficient. It just shows how they can turn over their inventory, like how quick they can turn it over. Days sales and inventory, same thing, consistent all 4 years. And days sales outstanding ratio is also pretty good. And then here you can see for their asset turnover ratio, they turn over their assets really quick compared to the industry, 1.69 compared to 5.2. And then inventory turnover, 13.1 compared to 49, which is a big jump. Days sales and inventory, 27, is actually high in the industry compared to 4.1. And then days sales outstanding, 29.39 compared to the industry, which is 40.6. And then here you see profitability ratios. It just calculates a company's ability to generate money. Gross margin ratio shows their ratios with the gross margin. There's the operating margin ratio, which shows that they were consistent, except for at the start they were at 0.03. There's the profit margin ratio, and we got the return on asset ratio and return on equity.
So for the profitability ratios here, we're below average on the gross margin ratio, and that's just so we're not producing our goods and average as efficiently as most companies in our industry. Operating margin ratio and the profit margin ratio are also a little below average, except for the operating margin ratio is above average. So we're operating at a higher, our return on sales is much better than most companies in our industry, but our total revenue that remains after all of that is a little below industry average. And then our return on assets is also below average, which we're not using our assets as effectively as we can be, as most companies are, and our return on equity is much higher, which is really good, which kind of helps balance out the return on assets. And then our market value ratios here just show how we compare to other companies in the market and how we're doing in the market. As you can see, we've kind of declined in our earnings per share pretty significantly over the past couple years. And our price to earnings ratio has actually gone up, which is good because we're earning more dollars on each share, but and so has our market to book value ratio, which we're kind of over evaluating our company compared to our market cap, so that's not great. But our earnings per share ratio is a little below, is very significantly below average, so probably need to get that up. Our price to earnings ratio is right around average, so we're beating it, and we're very above average on the market to book value ratio, so we're overvaluing our company compared to our market cap, which would overvaluate our stock price, seeing those decreases. Those are our answers, and that's our presentation. Thank you for watching.